In December 2017, a Reddit user mortgaged his house to buy Bitcoin at $19,000. 3 months later, it was worth $6,000. He lost everything. In November 2021, another wave of retail investors bought at $69,000. 18 months later, $16,000. They called it a generational buying opportunity both times. They were wrong both times. And right now, in early 2026, with Bitcoin hovering near 6 figures after its latest rally, the exact same patterns are forming again. But this time, there's something different happening beneath the surface that almost nobody is talking about. Bitcoin has had 4 major collapses in its history. Each one followed the same script: euphoria, institutional validation, mainstream adoption narratives, and then a 70 to 85% drawdown that obliterated late arrivals. What makes 2026 different isn't that the cycle has disappeared. It's that the players have changed. The 2017 crash was driven by retail panic. The 2022 crash was triggered by over-leveraged crypto companies imploding. But the next crash, if it comes, will be driven by something far more dangerous: the same traditional financial institutions that were supposed to make Bitcoin safe. Spot Bitcoin ETFs launched in January 2024. They were supposed to bring stability, legitimacy, institutional capital. And they did bring capital. Tens of billions of dollars flooding in from pension funds, hedge funds, wealth managers. But here's what nobody explained. Institutions don't buy and hold. They trade. They rebalance. They have risk models and quarterly redemption windows. And when those models flash red, they don't ask questions. They sell. Let's talk about how Bitcoin actually moves in 2026. Before the ETFs, price discovery happened on crypto exchanges: Coinbase, Binance, Kraken. Volatile, yes, but driven by genuine supply and demand from people who wanted to own Bitcoin. Now, the majority of daily Bitcoin price movement is determined by ETF flows, derivatives markets, and options expiry dates. Here's the structure. A pension fund allocates 2% of its portfolio to a Bitcoin ETF. That ETF doesn't hold Bitcoin directly in some cases. It holds futures contracts, or it holds Bitcoin but hedges with derivatives. When the fund needs to rebalance at the end of the quarter, the ETF has to sell. Not because Bitcoin's fundamentals changed, not because anyone lost faith in the technology, but because a risk algorithm in New York said, reduce exposure. Multiply that across hundreds of institutions, all running similar risk models, all rebalancing at similar times. Now add leveraged positions. In 2017, retail investors used maybe 2 times or 3 times leverage on exchanges. In 2026, institutions are using structured products with embedded leverage that most investors don't even understand they're exposed to. Collateralized lending, derivative wraps, synthetic exposure through notes and swaps. The math is straightforward. When Bitcoin drops 10%, leveraged positions get liquidated automatically. Those liquidations trigger more selling. That selling triggers more liquidations. The technical term is reflexivity. The simpler term is cascade. And the thing about cascades is they don't care about long-term value. They care about margin calls. Ask someone why Bitcoin crashed in 2018 or 2022, and they'll tell you scams, hacks, FTX, Luna, lack of regulation. Ask them why it might crash in 2026, and they'll say the opposite. We have regulation now. We have ETFs. We have institutional adoption. This is the maturation narrative. Bitcoin has grown up. It's safe now. But here's the disconnect. Institutional adoption doesn't mean institutional conviction. Most of the money that flowed into Bitcoin ETFs came from tactical allocators chasing momentum, not true believers planning to hold for decades. When Bitcoin was climbing from $40,000 to $100,000 in 2024 and 2025, every wealth advisor wanted exposure. Their clients were asking about it. They had to have an answer. But conviction and allocation are not the same thing. If you asked those same advisors whether they'd increase their Bitcoin position during a 50% drawdown, most would say no. They'd rebalance away from it. That's the job. Manage risk, preserve capital, follow the mandate. Nothing personal, just math. Meanwhile, the public perception is that Wall Street finally believes in Bitcoin. What Wall Street believes in is fee-generating products and client retention. Bitcoin happens to be both right now. But the moment it becomes a liability, the moment clients start calling angry about losses, the calculus changes instantly.
So what would a 2026 crash actually look like? It probably wouldn't start with Bitcoin itself. It would start somewhere adjacent. A leveraged crypto hedge fund that overextended. A stablecoin that breaks its peg under redemption pressure. A derivatives exchange that halts withdrawals during extreme volatility. Something that sounds like 2022 all over again, except this time it's connected to traditional finance through a dozen counterparty relationships that didn't exist before. The ETFs were supposed to separate real Bitcoin from the chaos of crypto markets. But money is fungible, and markets are connected. When Genesis filed for bankruptcy in 2023, it had institutional counterparties. When Celsius collapsed, it had exposure to traditional lending desks. The walls between crypto and traditional finance have been dissolving for years. The ETFs didn't build a firewall. They built a highway. Here's a scenario. Bitcoin drops 15% in a week due to some external shock. Geopolitical, regulatory, macroeconomic, doesn't matter. ETF outflows accelerate. Market makers who provided liquidity to those ETFs start hedging by shorting Bitcoin futures. That pushes the price down further. Retail investors who bought Bitcoin thinking it was digital gold see it behaving like a risk-on tech stock and start selling. Algorithmic trading systems detect the momentum shift and pile on. Within days, you're down 30%. Within weeks, 50%. And nobody did anything irrational. Everyone followed their model. The 2017 crash took 12 months to fully play out. The 2022 crash took about 8 months. The next one could happen faster because the market is more liquid now, more leveraged, and more algorithmically driven. Speed is not your friend during deleveraging. And here's the quiet part. Bitcoin has never experienced a real recession while institutional money was involved. It was created during a recession, yes, but it spent its entire adolescence in the longest bull market in history, 2009 to 2020, and only briefly touched traditional finance before the pandemic stimulus began. We've never seen how Bitcoin performs when pension funds are having liquidity crises, when sovereign wealth funds are pulling capital home, when credit markets freeze. We're assuming it acts like digital gold. It might act like digital venture capital. The bulls aren't wrong that Bitcoin has survived multiple death predictions. But survivorship bias is a hell of a drug. Just because it recovered before doesn't mean it will recover at the same pace or to the same heights, or that the people who bought at the top will still be holding when it does. The bears aren't wrong that Bitcoin is volatile and speculative. But being volatile and speculative doesn't mean something has no value. It means you shouldn't bet more than you can afford to lose. The problem is that in 2026, millions of people have done exactly that.
packaged inside products they were told were prudent. Here's what keeps risk managers awake. What happens when Bitcoin crashes and it takes parts of traditional finance with it? Not because Bitcoin is systemically important, but because the leverage is. Because the counterparty exposure is. Because somebody at a regional bank bought a structured note that was supposed to be low risk and turned out to be a leveraged bet on crypto volatility. We learned in 2008 that financial contagion doesn't follow logical paths. It follows collateral chains and margin calls and credit default swaps that nobody remembered existed. The crypto market is now deeply interconnected with traditional finance through ETFs, custodians, prime brokers, and institutional capital. When stress tests are run, they assume normal market conditions. They don't assume cascading liquidations across multiple asset classes simultaneously. Bitcoin might crash in 2026, or it might not. It might hit $150,000 before it crashes, or it might crash from here. Predicting the top is a fool's game, and market timing is mostly luck. But the structure is in place. The leverage is in place. The institutional capital with short time horizons is in place. And history doesn't repeat, but it certainly rhymes. The Reddit user who mortgaged his house in 2017 eventually recovered. Bitcoin came back. It always has. But he spent 4 years underwater, and he never bought back in. Fear is a more powerful emotion than greed, especially after you've lost everything once. The question isn't whether Bitcoin will crash again. It's whether you'll still be holding when it does, and whether this time, when the institutions that promised stability start selling, there will be anyone left to buy. The believers say this time is different. They said that last time too.